Hi, Greg.
Hi, Mary Jo. How are you?
Good. Thank you so much for speaking to Family First this morning.
Absolutely. You're welcome.
And I understand that you have something to talk to us about with, oh my gosh. I'm so sorry. I am just, getting my notes here. I'm so sorry. Okay. So you're, the insurance needs of people, and that there's a lot of people that have, that they are not covered. Is that right? I mean,
yes. Unfortunately, we're at a 50-year low for people that own life insurance. So either about maybe roughly 3 out of 10 people don't have any life insurance. Another 4 out of 10 people are just relying on like their coverage they have through their employer, and that's usually not enough. So it's a pretty big number when you think about people who are underinsured or have no insurance. That could be in a really tough position if something was to happen.
And can you just detail what the effects would be for somebody that doesn't have any coverage or enough coverage? What are the effects, and what would those events be that would cause, well, besides death, of course, but I mean, like, what are the other circumstances that would cause that strife for someone financially?
Well, when it comes to life insurance, oftentimes people have some life insurance in place and they're doing everything right, but they've never really sat down and said, okay, if something was to happen to me, what is the true cost for those folks that are left behind to survive and to maintain the lifestyle that I want them to live? So when you start looking at, okay, I want to have my mortgage paid off, I want to make sure that the kids go to college, I want to make sure that the bills are paid for, by the time that you use whatever coverage you may have through work or a current policy that you've gotten from years before, that money may already be gone, and you haven't even replaced that income yet. So there's still a pretty significant gap, because I always tell folks that you could be doing everything right. You know, you're doing everything that you're supposed to. You're saving for your retirement. You know, you have a nice cushion for emergencies in case the water heater goes out. You know, you've got money there into a college account for your children. You're paying your bills every month on time. But what happens is all that is dependent upon an income that somebody's making typically. And the best laid plans can get thrown for a loop if the unexpected happens. And that's where life insurance steps in, just to ensure that your family who's left behind can continue to be provided for and that all your goals can still be met.
And you said that it's mostly around employers. So if someone is self-employed or unemployed, what can they do to cover themselves?
Well, if you don't have access to life insurance through an employer, or if you're self-employed, you have to go out and get life insurance through an independent life insurance company and get an individual policy in your name. And so my recommendation would be just make sure that you talk to a trusted advisor, you know, somebody that you trust that's maybe been helping you with your finances. Don't be afraid to ask questions. Life insurance is one of those things that people generally don't understand as much as they need to, but be a smart consumer. Just understand what it is you're purchasing and make sure you only get what you need. And I would say lastly, what's real critical is to make sure that you only buy from a financially strong, reputable company, because you want to make sure that that company is going to be there for your family or your loved ones years down the road when you're no longer here. You need to make sure that company's there as well.
Is it that you're talking about like an A+? Is it an A++ or that kind of rated company?
It depends which rating organization you talk to, but the AA, AA+, AAA, it's a lot of letters, but typically the more A's you have, the better it is. So that's a good way to look at it.
And is there, I know that this used to be a big sort of conversation that was using life insurance as an investment when you did either did a long-term policy versus like a whole life versus term. Can you explain that a little bit?
Sure. Life insurance comes in two primary different forms. You have the term, or think of it as temporary life insurance, and you usually buy it for a set period of time, 5 years, 10 years, sometimes all the way up to 30 years. So term life insurance is for those temporary things, and think of your mortgage, for example. It may not feel temporary, but a 30-year mortgage is temporary. You have a 5-year car loan, so you tend to match up the coverage that you need to those short-term needs that you have, or those temporary needs that you have. But permanent life insurance, just like the name implies, is for those expenses that aren't going to go away for your entire lifetime. Think of a funeral expense. Think of final expenses maybe related to medical bills. So permanent life insurance is going to help cover those things, whether you pass away tomorrow or whether you pass away, 40 years down the road. That permanent life insurance is going to be there for those permanent costs or expenses that aren't going to go away. So what most people tend to end up with, as far as the proper solution for them, is a combination of a little bit of both. And again, that's where I go back to make sure you talk to a trusted advisor that can help figure out what that right amount and what the right type is for you.
And since Family First is focused on families, can you talk a little bit about insuring your children?
Yes, and actually what I'd like to do as well is talk about insuring a non-working spouse, because that's often a topic that's overlooked. And I'll just use myself as an example. I am the sole breadwinner in the family. We have 4 children, ages 12, 10, 7, and 5. My wife is a stay-at-home and homeschools all the children. So she does not earn an income outside the home. So sometimes it's not about an income that you're going to lose. It's about expenses that you're going to incur if something was to happen. So a non-working spouse, like in my situation, I'm all of a sudden going to have expenses if something was to happen to my wife that I don't have today, like daycare for 4 children and after-school programs and all the things that she does to help maintain the home throughout the day. So that's something that's often overlooked, that a lot of folks need to sit down and make sure that they have adequate coverage for their spouse. Now, when it comes to children, oftentimes, we haven't saved enough money like we should have. It's been shown that Americans have been pretty poor savers over the years, and sometimes if something unplanned or unexpected happens, that we don't have enough money set aside to take care of that. And the loss of a child could be one of those things, and a $15,000, $20,000, even a $5,000 funeral expense could wipe out people's entire savings because they haven't been prepared for that. So there's a way to insure children either through your own policy that you may have in place, or actually you can sometimes get policies directly in your children's names. So again, I would say first and foremost, make sure that the parents are adequately insured, and then look to potentially insure your children to make sure that you're prepared for that as well.
Awesome. Greg, thank you so much. Can you tell us where we can get more information about you and about about insurance in general?
Yes, you can visit our website at www.usaa.com/life-insurance, and you get lots of great information there for your listeners to look into.
Awesome. Thank you so much. This is wonderful.
Thank you.